Hello, my name is David and welcome to David Computes. In a recent video, I covered the two moving average crossover where I showed you how you calculate some statistics for that system, for that trading strategy, if you want to call it. And I tried to show you how the results were not great, although the idea of these videos is for you to learn how to use your own tools, to use ready available tools, and to do your own calculations so that you take your own conclusions about a setup or anything else. So following that video, I decided to counter and show something very simple that has much better results than the crossover of two moving averages, which is so often used or referred. So just to quickly give you some points on what this simple system is, and before we look how to calculate the results, is we look at two consecutive candles, and we look for candles that have the close higher than the open for both of candles, so meaning basically that they're up candles. And then we put another requirement where the body size of the candle is at least greater than a given value, either in points or in percentage. We'll go over it when we're actually looking at real numbers. And then I made no requirements on the higher lows for either candle 1 or 2. So basically the candle could be this, could be this. I actually made no requirements on that. So it's basically just has to be two consecutive candles. They have to be up candles, so the close is higher than the open for both of them, and the body size have to have at least a certain size for both of them. And then the setup is basically very simple. You go long on the close of the second candle. In this particular study that I'm going to show you, I use daily candles. So on the close of the day, you go long and you put the low on the lowest low. So obviously if it's this setup, the lowest low, it's this one. So you'll have the stop here. If it was to be like this, this would be the stop. So which one of the candles, whatever the candle is the lowest low, that will be your stop. And then the target, again, you'll see on the study, depends on the size of your R. Let's say, for example, if it's a 1R, meaning the target will be the same distance as it is from your open price to your stop. So in this case, your target will be would be somewhere above. So it will be the same distance, but to the upside, of course, this being a long. So I hope this is clear. So if we go to a spreadsheet and exactly have this this that we're talking about here. So again, I'm using a data set that I often use. This case is the Standard & Poor's 500 cash session from the first day of so the first trading day of 2004 all the way to almost the end of July of 2021. So almost over 17 years of worth of data. I won't go with a lot of detail on this chart. I'll show each one of the four formulas that I use to calculate each one of these. Again, there's no right or wrong way to do this. There's only the way that works for you. This is just an example how you could do it yourself quickly without doing a lot of work, without having to know any programming skills. Just use a simple spreadsheet. So I've started by basically just calculating what is the gain in percentage. So perhaps said here in percentage for any given candle. So this is daily candles. And then I just have another column here where I've just transported, so I've aggregated, so we can see the gains or losses as it progresses. And then this is the column that gives us our setup, our trigger. So basically it was the requirements we covered before. Here's the formula. So basically I require that it's 2 up days and the body size is a given size. In this case, the body size I defined was the body size has to be at least 0.22%. There was no particular reason why I chose this value. We can choose something else. is just to show you something. I chose this. We can play with it afterwards. In the end, you can see if I was to update, the date updates automatically, which is the point. But for now, let's just leave it at that. And then, so this is the formula if you want to see. There it is. If you want to replicate it, I won't go over the too much detail on this. Then I have another column where I put the open price, for the setup. This is the formula, and then another column where I showed what is your the stop size in points. So this is, in this case, would be 15.47 points of stop size. So that means the stop price, which is obviously this price minus the stop size. So that's your stop price, and then your target price, which is your open trade price plus, if it's 1 hour, will be plus 15.47. So let's say if we're using an hour of 0.5, meaning half, will be just half of this. So it will be 31 plus, give or take, 7.5.7.6 or 7, like that. So this is the formula. You can see again, I'm not going to cover this in details. For sake of simplicity, I'm going to put this back at 1 hour. So our target is the same size or same distance as our stop, so 1 for 1, so a reward to risk ratio of 1. And then I added another column where I calculated if the stop was hit. This is a simple formula, as you can see here again. And the stop hit always has priority, so always checks first if the stop is hit. So if for whatever reason you have a big candle and it reaches both the stop and the target hit, I'll always consider that the stop is hit first. Even if that's not the case, that's the standard, the default behavior. If you want, you could tune this to check which the targets is, which prices are reached first, the stop price or the target price. Obviously, to do that, you would have to have intraday data, not just a daily candle, and you have to have a much more complex spreadsheet for that. And of course, perhaps in the future video, I can show you how you could do this using code like Python, which I like very much, and how you could do this very easily, and you can have a much finer control over this. But for the purpose of this study, this is more than enough, more than adequate to see if this simple setup works. Then I have another column, which is basically the same, but it's to check if the target has been hit. And if it does, it will show you how much is the value of the gain or loss. Of course, if it's a stop, it's a loss, so a loss of 1.36%. So this is percent, and if it's a win, how much is that in percent? I didn't round it or anything. So then this column, I've called it. I have two more columns here. The loss of gain is just to extract the actual value. So you can see on the calculations, it shows a continuous set, and this one is just extracts it once, so you count it only once, one for the loss, one for the gain, and you can see the formula here. So that's the loss, very simple formula, and this is the gain, again, very simple formula. I'm happy to go over these details if I get enough requests. If you seem that this is complicated, I'm happy to explain this perhaps in the second video. Then I have yet another column where I basically just accrued the losses and gains. So I basically, from the first trade all the way from starting in 2004 all the way to 2021, and I just transport the total loss or gain. And then the last two columns, I just counted the number of consecutive wins and consecutive losses. So in the first column is consecutive losses. Let's just extend the column width here, and then the consecutive wins, the same thing. So there's the formula for one, and there's the formula for the other. And then, of course, by calculating the maximum value, I can see what was the highest number of consecutive losses and wins. So it turns out it was, for these parameters using this body size with this R, it was 5 consecutive losses was the highest observed, and consecutive wins were an occurrence 23 consecutive wins. And then I used the usual basic statistics. I count how many trades were done. So we had 63 losing trades, 134 gain trades in percentage, so that corresponds to 66% of gains, 33% of losses. The maximum loss, the minimum loss, of course, being a negative number, that means actually your bigger loss was 9.6%, and your smallest loss was 0.5%, rounding down. Your average loss, your medium, and then your sum of all the losses, and the same thing for the gains. I've did a similar thing here for the accrued values, just for our benefit. And I've added an extra field here, since I've recently also done a video talking about expectancy, because again I see a lot of content out there talking about win rates and reward to risk ratios independently, as if just having a high win rate is in itself an amazing thing. When without pairing that with the size of your wins, your losses, it means nothing. So the expectancy is what you should always use, and it's basically just your winning rate multiplied by your average win plus your loss your loss probability, or your loss rate multiplied by your average loss. Of course, if you're calculating your losses as a negative number, you just sum. If it's a positive, you subtract, of course. So you subtract from your wins, you subtract your losses. And of course, for any setup to be of a value, the expectancy has to be greater than 0. The bigger the number, of course, the better. So we've done this. So you can see just quickly out of the bath, it seems that you have a working strategy. It provides positive returns. So if you see here, that's after roughly 190 trades over the course of 70 years, you would have accrued 130% returns. Of course, the way that it's done, because I've embedded on the formula the values, you could play with this. Say, let's say instead of using a 1R, what would you do? So you see here with a 2R, you get a higher expectancy. Although the returns in this particular case are actually smaller in percentage, but the expectancy is higher. And you can play with this, and you can do as many values as you want and play around. And the same for the body size. If you say you actually want to accept smaller body sizes or bigger body sizes, you could do, and you can see how that impacts your study and how it changes your values. It's very, very simple. And then I produced a second sheet. Again, I want to show you how easy it is. Just you can visualize the data that you obtained. So here we are. This is just the same, just repeated it so you can see this is the data. This is your setup accrued, so you can see the progression as time progresses. And this is just without using any setup, just what is the gain or loss for the Standard & Poor's. So if you were to open a long at the open and close at the close, and this is the gains and losses. So you basically use this as your second benchmark. Of course, your first benchmark is just you buy and hold. If you're buying on the first day of 2004 and hold it all the way to 2021, end of July 2000, this would be your gain in percentage. So 395%. That's your first benchmark. But then you could have a second benchmark, which is you open every day and close at the end of session, and you transport. And I've plotted these two charts here. On orange is the Standard & Poor's 500, and on blue is our setup. So as you can see, it more or less mirrors the performance of the index. No surprises there, but you can see a lot of things. For instance, you can see how actually some of the years you despite of your numerous trades, you actually don't go anywhere. Like the entire 2004, you're actually slightly on negatives, slightly up day on 2005, 2006. And you can see there's like 2008 is actually a big loss day. The same, it mirrors the Standard & Poor's. And so you can see that some years better than others. So what I've done as well here is I've plotted the yearly gains of both the Standard & Poor's and the setup on the column side by side, so you can easily compare. So here you actually lose an entire year doing this, and you make nothing. You actually lose 1.27%. as opposite to the Standard & Poor's, which gains 8.69% for the year 2004. And I've done that for all the other, for each one of the years. You can see there are certain years that the setup actually does better than the index. Don't forget that this benchmark is only the cash session, so it doesn't take into account any gaps. So because you open the session and close at the end of the session, if there's any up gap, for instance, you lose that upside. And the same, if there's a down gap, you're not taking that loss of the down gap. This is just to provide you a benchmark. So you can see here what clearly the chart shows. 2008 is a big, 30% loss is massive. And compared to the Standard & Poor's, 40% loss. And then 2009, it rebounds from the bottom of the financial crisis, 2009. And here are the values. I mean, I don't want you to tell you if this is good or not, but I want just for you to see how easy to calculate is and that you can take your own conclusions. And this is just the sum of all the years. And perhaps one of the things I can do, and this would be a good exercise, is you can refine this. Perhaps you're thinking, okay, perhaps I could add something to this setup, and try to improve on this. And, there you go. It's an excellent exercise and shows you the potential you can do with this. And I hope this video was useful to you. And again, I just wanted to produce this video to counter the previous one I've done recently about with showing the trading strategy using the crossover of two moving averages. Which so often is banded as an example, but it is really does a disservice because it's really a bad system that doesn't work. So I showed you it's just a very simple system that works. It's not amazing, as you can see. You have full years where it doesn't provide you any returns, but it's just for you to work, and you can see there's very simple systems that provide much better results. Again, I'll leave you to take your own conclusions. The other thing I haven't done on this study, but again, it's another a good thing you could do, is I considered only longs, but perhaps you could do the same exercise using shorts. So if you have two consecutive down candles, again with a body of the same size using the same R, and you can see if that works, and you can use both in parallel, long or short. But I leave that study to you. I'm going to finish this. I'm trying to keep this video short. I hope you enjoyed it. I hope you find this useful. Thank you very much for watching, and hope to see you again.